A slowdown in the market is an opportunity for betting. Intermediate traders must understand that not every setup works in every market. They need to master the strategy of knowing which setup to use when. This knowledge doesn't come from just reading charts. It comes from repeated observation and review. According to Murphy, the market is like clothing. Just as clothes change, intermediate traders must change with it. Now let's talk about confirmation versus anticipation. Beginners usually make predictions. They guess whether the market will go up or down. But intermediate traders act based on confirmation. Murphy teaches that a setup isn't mature until it's confirmed. A breakout should only be considered true when the price firmly breaks the resistance with volume and stays above it. Introduction. Have you ever wondered what the real secret to understanding market movements is? Every day, millions of people sit in front of screens, look at charts, read news, and rely on tips, but they still remain confused. Why? Because they haven't grasped the depth of the intermediate markets as taught by experts like John Murphy. This book is for those traders who want to move beyond basic technicals and reach a level where analysis is not just a game of formulas, but an art form. Chapter 1. Understanding intermediate markets. Understanding intermediate markets means knowing what's happening behind the price action, psychology, momentum, volume, and most importantly, context. In the first part of this chapter, we'll explain these fundamentals in a different language than what's typically found in books, which is often difficult to grasp. First, we'll talk about trends and their internal phases.
Many people think a trend is either up or down, but the truth is, every trend has three phases: accumulation, public participation, and distribution. A thoughtful trader knows that the real money isn't made by following the trend, but by identifying its phases. The accumulation phase is when smart money slowly builds positions. The public participation phase happens when news is good, indicators confirm, and everyone starts to enter. Recognizing this phase can save you from countless bad trades. Now let's talk about the real psychology of support and resistance. John Murphy doesn't just see technical charts as lines and candles. He reads each level as a reflection of crowd behavior. Support is the level where buyers were active in the past. Resistance is where sellers provided supply. But the real art is understanding how these levels will react in the future. An intermediate trader also knows that once support is broken, it becomes resistance, and vice versa. This isn't just a basic rule. It's an emotional cycle based on traders' reactions. Grasping this psychology transforms a trader from mechanical to thoughtful. Now let's talk about volume analysis. Many people ignore volume, but Murphy considers it a major weapon. He says volume confirms price. That is, if the price goes up but the volume decreases, you should understand that the movement is weak. And if the price falls but the volume is high, you should be scared. An intermediate trader needs to recognize volume spikes, divergences, and drive zones. The dance between price and volume is the real rhythm of the market, and Murphy teaches you how to hear that music. Now let's talk about chart patterns, but not like a beginner. According to John Murphy, a chart pattern is not a guarantee of the future. It's a structure that reveals crowd behavior. A head and shoulders pattern is not just a break of the neckline. This pattern reflects the psychology of traders, where a failed rally scares the crowd and then panic selling begins. Similarly, a triangle pattern is a squeeze where energy is building up and the breakout is an emotional release. At the intermediate level, context is more important than the pattern itself. Is volume supporting it? Is the trend structure intact? Does this pattern fit into the larger market narrative? An intermediate trader must ask all these questions.
Now, let's talk about indicators. Beginners use indicators as signals. Sell when RSI is overbought. Buy when MACD crosses. But John Murphy teaches that indicators are not signals, but tools, and they must always be read within the context of price.
An intermediate trader will look at the RSI, but also check its range. Is it in a bull zone or a bear zone? They won't place it above the price action. Now, let's talk about intermarket analysis, John Murphy's most powerful contribution. Intermarket analysis says that no asset class is isolated. Equities, bonds, commodities, and currencies all are linked to each other. It is important for intermarket analysis to understand what effect a strong dollar has on commodities. If bond yields fall, how will the equity sectors react? These relationships are not only understood by economists, but also by professional traders. Through this method, Murphy shows you the bigger picture so you can trade the core story, not the noise. And finally, let's talk about mindset. At the intermediate level, mental clarity is more important than technicals. Murphy believes that no strategy will work without emotional discipline. A thoughtful trader trades with a system, following rules, not emotions. They know that losses will happen sometimes, but if the strategy is correct, they will have an edge in the long run. And this edge is what separates an intermediate trader from the crowd. Chapter 1, Part 2. When a trader moves from the beginner to the intermediate level, they first have to redefine themselves. They are now not just learning to trade, but understanding the layers of why, when, how much, and how behind every decision.
John Murphy teaches us that the biggest danger of the intermediate stage is overconfidence. When a beginner catches some good trends, understands some patterns, and charts start to feel a bit familiar, a false belief begins to grow that they now know everything. But this is where the market delivers the biggest blow. Murphy says the market is like a mirage. It makes you think you're in control when you're not. The first lesson for an intermediate trader is to always think of themselves as a beginner and keep learning. Now let's talk about the systematic approach. A beginner often operates on instinct and feelings, but an intermediate trader needs a system that has logic, process, and repeatability. Murphy states that success in trading is not magic, but an edge, a method that, over time, makes you a little better than others. And to get this edge, you need a system, some rules, and discipline. An intermediate trader should ask themselves these questions. What are my entry criteria? Where and why is the stop loss? How will I determine position size? When and on what basis will I exit? Murphy emphasizes that if you can turn these 4 points into a process, you have moved from random trading to professional trading. Now let's talk about confirmation bias and selective perception. The biggest enemy of an intermediate trader is their own brain. John Murphy explains this psychological trap this way. We see what we want to see. That is, if you have decided that the market will go up, you will only look for signals that confirm your idea and ignore the opposite ones. At the intermediate level, a trader has to learn to be neutral. They have to read every signal objectively. Their job is to listen to the market, not their own mind. Now let's talk about backtesting and review. Murphy says that an intermediate trader must learn not just by live trading, but by looking back. Write down every trade, state the reason, note the entry and exit, and then ask yourself these questions. Why was it right, and why was it wrong? Murphy gives a principle. Your best teachers are your last 20 trades. An intermediate trader should treat their own trade journal like a sacred document, because that's where the real story of their growth lies. Now let's talk about noise versus signal. The biggest confusion at the intermediate level is with the daily headlines, YouTube videos, tweets, and news flashes. Murphy gives a great insight here. Markets discount everything, including noise. So your job is to come for the signal. This means you have to rise above the daily chatter and understand the price action. The market discounts everything, even the noise.
So your job is to come for the signal. This means you have to rise above the daily chatter and focus on the price. Murphy calls this market regimes and says that a good trader is one who can adjust their strategy to market conditions.
An intermediate trader has to understand that success is not in being rigid, but in being flexible and aware. Now let's talk about entry timing. Many times, an intermediate trader gets the direction right, but enters at the wrong time. In this context, Murphy talks about momentum indicators like RSI, stochastic, or MACD, but he says they should not be seen as signals. Price action is primary and indicators are supporting tools. This distinction can be life-changing for an intermediate trader. Now, an even more important aspect, trade management. An intermediate trader has to learn how to manage a trade once they are in it, how to trail a stop loss, when to book partial profits, and when to exit the entire position. Murphy's general mantra is, protect your capital, always. Profit is a byproduct. At the intermediate level, you're now playing not just to make money, but to save it. And finally, let's talk about the internal mindset. An intermediate trader's biggest breakthrough comes when they learn to calibrate their internal mindset with external strategies. Fear, greed, doubt, ego, these are the internal variables that make a strategy successful or a failure. When an intermediate trader starts to track their own psychology, they evolve from a trader to an investor and then a strategist. So the summary of this part is that an intermediate trader is not one who can read charts, but one who learns to read themselves like a chart. Chapter 2, Part 1. Have you ever felt that on some days your trading has an extraordinary clarity? Everything looks clear, you understand the charts, and you're confident? This is the most complex illusion for an intermediate trader, where they think they understand everything, but in reality, they mistake noise for clarity. At this stage, Murphy asks the trader a question. Why are you reading the market, and when should you act on the chart? Now let's talk about the most basic component, trend identification. Beginners are happy to see a trend, but an intermediate trader has to recognize the trend's context, strength, and structure. Murphy states that there are only 3 types of trends, uptrend, downtrend, and sideways, but an intermediate trader has to see if this is just a local trend or if it's connected to a larger time frame. Is the short-term uptrend you're seeing against a long-term downtrend? According to Murphy, a thoughtful trader must master multi-time frame analysis. This means you look at an asset on daily, weekly, and monthly frames and try to sync their behavior. This is the perspective that filters out noise and amplifies the signal.
Now, let's move on to a topic that most people take lightly: time frames. Murphy believes that choosing the wrong time frame is the most common mistake of an intermediate trader. For example, if you're looking for a setup on a daily chart, but taking entries and exits on a 5-minute candle, you're trapping yourself in unnecessary volatility. According to Murphy, your choice of time frame should be consistent with your objective. If you are a swing trader, focus on the 4-hour and daily charts. If you are a positional player, the weekly chart will give you more reliable insights. This small change can increase your win rate and reduce mental fatigue. Now we come to an advanced concept. It's important for an intermediate trader to understand that a stock looking good is not enough. It needs to be compared to its sector and the broader market. Murphy teaches that if a stock is consistently outperforming the Nifty, it is attracting both momentum and institutional attention. This concept is called relative strength. An intermediate trader should learn how to create ratio charts, such as stock versus Nifty or sector index, so they can see relative strength, not absolute. This method will help you separate the outperformers from the laggards. Now, a very overlooked but powerful aspect, volatility awareness. Intermediate traders often ignore volatility. Murphy states that volatility is not just a reflection of fear, but also an indicator of both opportunity and risk. An intermediate trader needs to understand that high volatility doesn't mean high risk as long as you have proper risk management. Murphy emphasizes that measuring volatility, such as the average true range, gives you clarity in determining your entry, stop loss, and position size. Not only that, he says that the real maturity is not in fearing volatility, but in understanding it and making it part of your strategy. Now, another depth: the trap of correlation. Murphy explains that intermediate traders often forget that a market doesn't move solely on its own. The rise in crude oil prices can affect Indian equities. The movement of the dollar index can change the pattern of gold. From Murphy's intermarket perspective, it is important for the intermediate trader to see how their asset interacts with other asset classes. A common example: if the USD INR is going up, IT stocks will gain strength. Understanding this relationship is intermarket intelligence. Now let's talk about scalability. Murphy says that an intermediate trader should understand whether their strategy can work consistently in any market condition, and if not, when to change it. Scalability is not just about position size, it's about the thought process where you can refine a strategy to replicate it methodically. An intermediate trader needs to understand that once a system is in place, the goal should not be to change it repeatedly, but to execute it with discipline and measure it based on real-time performance. The purpose of this entire section was clarity versus complexity. To teach an intermediate trader that creating a strategy and implementing it are two different things, and if either is weak, the entire system's balance is broken.
Chapter 2, Part 2. When a trader moves past their initial experiences and reaches the intermediate level, the biggest change comes in their way of thinking. They no longer just guess by looking at charts. They start to understand that behind every market movement, there is some purpose, some reason, and a lot of psychology. And this is the art of decoding that Murphy teaches us. At this level, Murphy tells the trader not to just chase technical indicators, because indicators are just the result, but the intermediate trader must understand the causes. The causes are hidden in the price structure, behavior patterns, and the market ecosystem. The most important pillar of intermediate trading is self-responsibility. Murphy repeatedly emphasizes that at the intermediate level, you stop blaming, not the market, not the news, not the strategy. An intermediate trader asks themselves these questions: did I create a clear plan before taking the trade? Were my stop loss and target based on logic? Did I keep my emotions neutral? Murphy has a great quote: "Markets don't reward opinions, they reward discipline." Now let's talk about a key concept: risk to reward ratio. Beginner traders often only think about profit, but an intermediate trader knows that a bad reward ratio can make even the best setup useless. Murphy's mantra is, never take a trade where the potential reward is less than the risk. Maintaining a 1-to-2 or 1-to-3 ratio should be the lifestyle of an intermediate trader. This not only maintains discipline, but also builds confidence that every trade will not harm your overall capital. At the intermediate level, trade selection is less important, and trade rejection is more important. Now, a very deep concept: market narratives versus price reality. Murphy states that news always tries to justify the price, but an intermediate trader understands the price movement and sees the narrative as just an external input. Murphy's principle is, price is the truth, everything else is just noise. The intermediate trader understands the language of price action. They know that if buying comes on every dip in a stock, there's probably some smart accumulation happening, even if the news says otherwise.
Now let's talk about mental capital. Just like physical capital or your money, you also have an invisible currency: mental capital. This is what defines your patience, emotional strength, and clarity of decision-making. Murphy believes that an intermediate trader must know not just capital management, but also mental capital management. You can do 4 to 5 trades a day, but every losing trade depletes your emotional energy. If you overtrade, take revenge trades, or make emotional entries, you've not only lost money, but also your mental bandwidth. An intermediate trader is one who maintains this balance. fewer trades, high conviction, and controlled psychology. Now let's talk about understanding probabilities. Beginner traders look for certainty, like, will this trade definitely work? But an intermediate trader accepts that no trade is 100% certain. Murphy says trading is a game of probabilities, not predictions. When an intermediate trader takes a trade, they don't think about whether this trade will work or not. They just look at whether the setup is reliable. Did this setup work in similar past situations? Is my entry clear? And is my exit defined? This probabilistic mindset moves them from confusion to clarity. Now, let's go to an element that is often ignored: trade duration. Murphy states that an intermediate trader should have a clear idea of the time frame they are working in. Are they an intraday trader? Are they a swing trader or positional? If your setup is for a swing trade, but you're managing it with an intraday mindset, you might exit early or take a loss. An intermediate trader executes every trade with a plan that includes entry, stop loss, exit, and duration, all decided beforehand. Now let's talk about the balance between diversification and focus. Murphy makes this very clear. Trading in more instruments is not maturity. It is confusion. It is important for an intermediate trader to learn which 2 or 3 instruments they can master, whose behavior they understand, and whose price action feels familiar. Murphy says, don't try to be everywhere. Try to be right where your edge is.
Now, an extremely important topic: tracking performance metrics. At the intermediate level, a trader should be able to audit their own trading. They know that not just profit and loss, but the following metrics are more important: win rate percentage, average risk-to-reward ratio, maximum drawdown, and monthly performance comparison. Murphy states that real growth happens when an intermediate trader starts to think of themselves not as a trader, but as a business. An intermediate trader should do a weekly review. Were my decisions disciplined this week? Did I do anything outside the system? If yes, why? Now, the final and most profound insight: detachment from outcomes. An intermediate trader's growth happens when they stop thinking about the outcome and find perfection in the process. Murphy's golden line is, your job is to protect your edge. Profit is just a byproduct. When an intermediate trader understands that every trade is not a result, but a process validation, they move trading toward mastery. In this section, we saw that trading is not a superficial game. It is a well-structured, process-oriented, and mindful journey. And an intermediate trader's real job is to make themselves a better trader every day. This document, which appears to be a translation of a chapter on trading, breaks down the journey of an intermediate trader. It is structured into multiple parts, covering a wide range of topics from technical skills to psychological maturity. Chapter 3, Part 1. This chapter follows John Murphy as he takes us deep into trading to build the technical skills, confidence, and long-term consistency of an intermediate trader. The key takeaway is that success isn't about who knows the most, but about who follows their rules best. Murphy's line is a wake-up call for intermediate traders, a stage where maturity is more important than skill. It's where understanding a chart and acting calmly is the real key to success.
Technical mastery. An intermediate trader must look beyond a flurry of indicators and learn to read the core price structure. According to Murphy, every chart tells a story through support, resistance, consolidation, breakouts, and breakdowns. A trader at this level must be fluent in this language. Price action is more powerful than indicators because it reflects market psychology directly and first. A strong bullish candle, a clean breakout, or repeated rejections at resistance, these all signal the market's intent. The trader should work with patterns like flags, triangles, and head and shoulders, But not just visually, they need to understand their psychology. Momentum and volume. Murphy explains the relationship between momentum and volume. When price and volume rise together, the movement is sustainable. But if price goes up while volume decreases, be cautious. The movement is weak. An intermediate trader needs to understand that volume is a lie detector. No matter what the price shows, volume reveals the reality. Murphy's strict principle is volume precedes price. This means a change in volume often signals a major move before the price reflects it, and a skilled trader must recognize this signal to gain an advantage. Correct use of indicators. Murphy advises against chasing too many indicators. Instead, choose one or two indicators, understand them deeply, and grasp their context with price. For example, the RSI, Relative Strength Index, shouldn't just be seen as overbought or oversold. An intermediate trader should look at what the RSI's divergence is saying. Is the RSI making lower highs while the price makes higher highs? If so, this signals weakness. Murphy also considers MACD, stochastics, and moving averages useful, but emphasizes that to master them, you must learn to interpret them in conjunction with price.
The power of confluence. For an intermediate trader, confluence is a game changer. It's when multiple factors align in one direction, for example, bullish price action at a support zone, an RSI showing a reversal from oversold, and a bounce from the 50-day moving average. The confidence in such a trade increases exponentially. Murphy states, confluence is confidence. A trader at this level should check how many factors are in their favor before each trade. A single signal is not enough. 3 or 4 aligning signals make an entry logical. Trading setups versus market conditions. Murphy points out that not every setup works in every market. An intermediate trader must understand that breakout strategies work well in trending markets, while mean reversion works better in sideways markets. The key is to master the art of knowing when to use which setup. This knowledge comes not just from reading charts, but through repeated observation and review. Murphy's words, "The market changes its clothes. A trader must adapt to the new outfit." Confirmation versus anticipation. While beginners often anticipate or guess market moves, intermediate traders act based on confirmation. Murphy teaches that a setup isn't mature until it's confirmed. A breakout is only real when the price breaks resistance with strong volume and holds above it. An intermediate trader must have the patience to wait for a signal, avoid premature entries, and join the move only when confirmation is received. Technical approach to stop-loss placement. Murphy stresses that a stop-loss should not be a random number. It should be defined by the chart's structure. An intermediate trader should ask, is the stop-loss below the recent swing low? Is it a logical invalidation point? Is the distance between the stop-loss and entry appropriate for my capital? Murphy states that a technical stop-loss must align with a risk percentage. If your stop-loss is large, keep your position size small. This approach leads to long-term sustainability.
Entry timing versus setup quality. Murphy believes that a good setup doesn't mean you should enter immediately. Sometimes the setup is right, but the market environment doesn't support it. An intermediate trader must have the patience to wait until all elements align. A great setup can become an average trade due to poor timing. The biggest lesson from this section, an intermediate trader views technicals not just as tools, but as a mindset. They understand the sentiment behind the signals, identify the risk within a setup, and seek clarity before execution. Chapter 3, Part 2. Murphy says strategy creation is one part, but the real game is executing it correctly at the right time. An intermediate trader must understand that the trade they execute, not just the one they planned, defines them. Execution clarity. Murphy repeatedly states that an intermediate trader must be clear before every trade when to enter, when and where to exit, what trigger is needed for entry, on what criteria to cancel the trade, and is the volume participation correct. This clarity saves you from panic and leads to consistency. Position sizing. While a new trader thinks in terms of lots or quantity, an intermediate trader measures each position in terms of risk percentage. Murphy's principle is the risk per trade must remain constant, but the size must adapt. If you risk only 1% of your capital on each trade, the position size should be smaller for a trade with a large stop loss and larger for one with a tight stop loss. This calculation should become second nature through practice.
Entry triggers. Murphy differentiates between a setup and a trigger. A setup signals that something might happen, but a trigger tells you to act now. An intermediate trader needs clear triggers, such as the price breaking the high of the previous candle, a pin bar forming at support with a volume spike, or a rejection on a pullback after an EMA crossover. Triggers are specific and more actionable than setups, and an intermediate trader backtests all their triggers to establish their reliability. Trade management. Murphy believes that the strategy after entry is more important than the entry itself, because this is where greed, fear, and impatience take over. An intermediate trader needs to know when to take partial profits, how and when to trail the stop loss, and when to exit the entire position. Murphy advises that the exit strategy should have two parts. 1. A pre-planned exit defined before the trade. 2. A real-time exit adjustments made as market conditions change. A good trader maintains flexibility without being emotional. Emotional anchor. An intermediate trader must learn to map their emotions. For example, high confidence in a trade can lead you to ignore a stop loss. After 2 losing trades, you might enter the next one with a revenge mindset. A trader must understand that with every trade, they invest not just money, but also their emotions, which often cause losses or burnout. Murphy stresses the importance of journaling. After each trade, note the reasons for entry and exit, your emotions, and any lessons learned. This builds a meta-awareness of yourself, which is a greater advantage than the market itself.